We're going to go over Rhonda's camp class exercise, and it's going to illustrate to us the difference between cash basis and accrual basis accounting and why it matters. So let's see what we have here. Rhonda runs a 6-week summer camp in the North Georgia mountains, 3 weeks in June and 3 weeks in July. 20 campers signed up, each paying $2,000 for the 6-week session. She received 20% down payment in March when the campers booked their sessions, and the remainder when they arrived in June. She pays 4 counselors $3,000 each in August. She bought supplies in April. At the end of June, she had 2,000 supplies left over, and at the end of July, she had 350 left over. Utilities, horse feed, and food were charged to the MasterCard and paid at the end of August, which was about $1,000 a week for each of the sessions. So on a cash basis, what revenue would we have? Well, on a cash basis, you would record it when the cash is exchanged, not when it's earned or used up. Accrual basis, we would record it when it's earned or used up. So when did cash come in? We got 20% down in March. So let's see, 20% times 20 campers times the $2,000 fee. So that came in March, and when did the rest come in? In June we got the rest. So we got 0.8 times 20 campers times the $2,000 camp tuition. So that, on a cash basis, that's how revenue would have been recorded. That's not when it got earned. It got earned when they provided the camp experience. 3 weeks in June and 3 weeks in July. So on the accrual basis, we would record the 20 campers times the 2,000 times half of it for June and half of it for July. So it's 40,000 either way, right? The question is, when should you record the revenue? Accrual basis accounting says you record the revenue when you provide the services. Well, but the cash came in before you provided the services. So what are we supposed to do in March when we get that cash in? We record unearned revenue until we earn the revenue in June. When the rest comes in, that goes in unearned revenue, and it gets pulled out of unearned revenue when they provide the camp experience. And so you would need adjusting entries to remove it from unearned and put it in earned. And when you debited cash, you would credit the unearned there. All right, let's look at the cost of the counselors. She pays $4,000, $3,000 each in August. So the cash goes out in August. So there are how many counselors? Let's see, 4 counselors. And she pays them $3,000 each for the entire summer. So in August, she's writing a check for $12,000 to the counselors. But when did the counselors earn that money? When is the salary expense or the counselor expense incurred? It's incurred when the counselors provided the experience for the campers in June and August. So half of that should have been accrued in June and the other half in July, and a payable should have been set up, and then when the payment was made in August, that payable would have been relieved. So accrual basis would have matched the expenses, that's the matching concept, would have matched the cost of the counselor with the earning of the camp fees. All right, let's go up to supplies. Let's see, Rhonda bought supplies in April, so that's when the cash went out. I guess we could make expensive negative. I guess that would make some sense there. Okay, so now when did the supplies get used up? That's when they should be expensed on the accrual basis. On the cash basis, they go out when the check's written. Okay, let's see. At the end of June, they had 2,000 supplies left over. So we started with 4,000. At the end of June, we had 2,000 left over, meaning that half of them must have gotten used up in June. Then at the end of July, we had 350 left. So that means that we must have used up 1,650 in July. And then we still have supplies on hand of 350 on our balance sheet at the end of the summer that I guess we can use for next year, crayons or markers or paper, whatever it was. All right, what about the horse feed and the food? That was charged to the MasterCard, and so it was paid in August. From the accrual basis, though, that the expense associated with that, even though the payment happened in August, the effort, the food was used up and the horses were cared for in the camp weeks, not when they were paid. So from the accrual basis, the profit for the camp was $9,000 in June and $9,000 in July. Well, $9,350 in July. So this would be the profit that the camp would recognize from the 3 weeks in June and 3 weeks in July. That's the fees that they earned and the things that they consumed. But this is not at all the cash pattern. The cash pattern would have showed that they made profit in March, they lost money in April, they made profit in June, and they lost money in August. That makes no sense, right? That's just when the cash moved, but that's not when the relevant activity occurred. That's not when the revenue was earned, and that's not when the things that were used up in generating that revenue occurred. So that is why we don't use the movement of cash as the trigger for when to record revenues and expenses. And that is why we need to keep track of things like prepaids and unearned, why we need to accrue revenue and accrue expenses that have not yet been paid or collected, so that we can accurately convey the impact of the events of the period, even if the events have not yet been settled in cash.